It is Monday, March 9th, 2026. Drop OG in the comments if you have been watching this market in real time today, because today was one of those sessions that separates the people who understand market mechanics from the people who just read headlines. And if you only read the headlines today, you got the story completely backwards. Here's what the headline said. Oil hit $120. G7 called an emergency meeting. Oil crashed back to $100. Silver is at $84. Here is what actually happened. WTI briefly breached $120 per barrel in overnight trading. Brent surged to $119.50, the largest single-day oil gain since 2020. Then both pulled back to around $94 to $100 through Monday morning. Sprott money, a 30% surge followed by an 18% reversal in under 4 hours on the same day. And silver dropped to $79 at Sunday's open, clawed back every cent, sitting at $84.90 right now. Most people watching silver today saw the $79 number and panicked, or they saw the $84.90 recovery and cheered. Both reactions missed the actual story. The actual story is in 3 specific things that happened today that tell you exactly what the next 2 weeks inside this market look like, and none of them are the oil price. Every number I give you is public and verifiable. Links are in the description. I sell nothing. No memberships. No Discord. No paid alerts. If you see my name on any paid service, that is not me. Section 1. What the $79 flush actually was, and why it is not what it looked like. Since the US and Israel began airstrikes against Iran on February 28th, oil prices have soared, notching their largest weekly gain since at least 1985. Sprott money. Every risk asset that had been performing, gold, silver, oil, energy equities, went into Sunday's open at extended prices with significant unrealized profits sitting in institutional books. When oil gapped to $120 at Sunday's open, here's what happened in the background. Funds that were long oil from $70, $75, $80 were suddenly sitting on 50 to 70% gains. Those gains are real money. And real money in a volatile market creates a specific institutional behavior, raise cash against exposure elsewhere. The assets that get sold to raise that cash are not the underperforming positions. They are the liquid assets still showing profits. Gold had been performing, silver had been performing. U.S. stocks plummeted into the red as Monday's trading session opened. The S&P 500 and the Nasdaq both lost roughly 1.3%, while the Dow fell 1.6%. Sprott money. What you saw in silver at $79 was not a structural breakdown, it was deleveraging. Funds facing losses in equity positions and needing to meet margin calls sold liquid assets still showing profits. Silver had been at $121 in January. Even at $84, it was showing meaningful gains to anyone who entered below $70. Those positions got sold, not because silver's fundamentals changed, because the funds needed cash. The competitor script put it exactly right, and I'm going to give you the same read. Gold outperforming silver in that initial flush is the textbook signal of defensive repositioning rather than a structural break. When silver falls harder than gold in a deleveraging wave, it is not because silver is weaker. It is because silver carries more industrial demand sensitivity being priced alongside the monetary demand. The $79 low was a deleveraging event. Silver clawing back every cent to $84.90 by early afternoon is the physical demand underneath absorbing every offer. You cannot manage a paper price forever. You cannot fabricate warehouse receipts. Section 2. What the $120 oil move actually means. The 3 transmission channels into silver that nobody combined today. WTI briefly breached the $120 mark in a session defined by raw panic and historic volatility. The catalyst is the de facto closure of the Strait of Hormuz following coordinated Iranian missile and drone attacks on transit vessels and coastal infrastructure. Here's the specific number that most oil analysts are not connecting to silver. U.S. oil prices have risen by more than $55 per barrel over the past 3 months, a near doubling. Models suggest that if prices hold at current levels, U.S. GDP growth could contract by 0.5%, erasing approximately $160 billion in economic output. Gold, silver. $160 billion of GDP contraction from an oil shock into a war economy with a Federal Reserve that is already frozen between inflation and recession. Let me show you exactly how that $120 oil spike transmits into silver through 3 specific channels. Channel 1, the cost floor. Every ounce of silver mined requires diesel for drilling equipment, natural gas for smelting, and petroleum-based chemicals for the hydrometallurgical processing that separates silver from host rock. When oil doubles from $60 to $120, the all-in sustaining cost of silver production rises by approximately $6 to $9 per ounce for the average primary silver miner. The paper price at $84 compresses margins that were already thin at $70 oil. If oil sustains anywhere near $100, which is the current price after the G7 pullback, new silver mine development becomes economically marginal. The era of cheap, predictable energy is, for now, a relic of the past. That sentence applies to silver mining costs as directly as it applies to airline fuel bills. Channel 2, the inflation trap. Investors should brace for a period of sustained high inflation and potential interest rate hikes as central banks struggle to contain the second round effects of this energy shock. The competitor script made this point precisely, and it is correct. If WTI sustains near $100 to $120 for 3 months, U.S. CPI inflation pushes toward 3.7%. That is the highest inflation reading since September 2023, into a war economy with a Federal Reserve already navigating mixed signals on growth and price stability. You cannot cut into 3.7% inflation. You cannot hike into a war-driven growth slowdown. The Fed gets trapped between two bad options simultaneously. And when the Fed is trapped, the bond market cannot decide whether to price inflation or recession, which means yields become unstable, which means hard assets, including silver, become the default hedge for institutional capital that cannot find a clean directional bet in paper assets. Wednesday is CPI, Friday is PCE, both landing inside an active oil supply shock. If CPI runs hot, which it will if $100 oil feeds through into the data, the paper sellers get a narrative window. But the physical demand underneath does not care about a narrative window. Physical demand cares about supply, and supply is what the third channel addresses. Channel 3, the shipping insurance mechanism. The warnings and subsequent attacks on vessels caused tanker traffic to drop by approximately 70%, with over 150 ships anchoring outside the strait to avoid risks. Discovery alert: 150 ships anchored outside the strait, unable to move. That is not an oil story. Those ships carry silver refinery feedstock. They carry copper concentrate. They carry the industrial raw materials that flow between Asia and the Middle East and Europe. When shipping insurance is removed, which it was on March 5th for Hormuz transit, the supply chain for every industrial metal that moves through the Gulf of Oman ceases. Not just oil, every commodity that moves through that choke point. As of March 8th, production at the 3 main oil fields in southern Iraq had dropped by 70% since the start of the war, from 4.3 million barrels per day to 1.3 million. Discovery alert: Iraq, Saudi Arabia, Kuwait, UAE. Every producer whose output transits Hormuz is either cutting production or rerouting through longer, more expensive routes. That supply chain disruption is already 9 days old. The Iran war has disrupted 20% of global oil supply for 9 days and counting, more than double the previous record set during the Suez Crisis of 1956 to 1957. J.P. Morgan doubled the Suez Crisis record on day 9, with a new hardline supreme leader in Tehran who has already launched missiles since his appointment yesterday. Section 3, the G7 response. What 400 million barrels actually solves and what it does not touch. French Finance Minister Roland Lescure, chairing a meeting of G7 finance ministers, said the group is prepared to act but has not yet reached the threshold for a coordinated release. The decision comes despite earlier reports that at least 3 G7 members, including the United States, were actively discussing a drawdown of up to 400 million barrels. Metal Sedge. Let me give you the specific arithmetic of why 400 million barrels is a window, not a solution. Roughly 15 million barrels of crude oil, about 20% of the world's oil, typically transit the Strait of Hormuz every day. J.P. Morgan. 400 million barrels divided by 15 million barrels per day of Hormuz flow equals 26.7 days of replacement capacity. At the current pace of production shut-ins, Iraq at 70% down, Kuwait cutting, Saudi Arabia beginning curtailments, the actual daily shortfall is not 15 million barrels. It is the net impact of reduced production plus blocked transit. If the Strait of Hormuz remains unnavigable, production cuts would likely rise to 3.3 million barrels per day by day 8, to 3.8 million barrels per day by day 15, and to 4.7 million barrels per day by day 18, according to JP Morgan Chase analysts. Sprott money. We are on day 9. JP Morgan says the shut-in is already at 3.3 million barrels per day and rising toward 3.8 million by day 15. At 3.8 million barrels per day of net shortfall, 400 million barrels covers approximately 105 days, a little over 3 months. If the war continues for the 4 to 6 week timeline Trump suggested, the SPR release is theoretically sufficient. If the war extends beyond that, the reserves are exhausted and the market faces a supply gap with no buffer. The hold is likely to disappoint traders who had been banking on a supply-side intervention to cool the rally. Metal Sedge. The G7 said they are prepared to act. They did not act. They said necessary measures. They did not release barrels. The oil market reacted to the possibility of a release, not a confirmed release, and dropped 18% from the $120 high. An account opened a 5x leverage short on crude oil roughly 2 hours before the G7 reserve reports emerged and walked away up over $1 million as oil prices fell. Gold, silver. Whether that was insider trading or coincidence is a question for regulators. The documented fact is that someone knew the G7 statement was coming before the market did. Here is what the G7 response means for silver specifically. The SPR release addresses oil supply. It does not address silver supply. It does not reopen the Shanghai export control system. It does not register new ounces into COMEX vaults. It does not resolve the 429 million ounce paper claim against 86 million ounces of registered inventory. It does not restart the 44 licensed Chinese silver exporters. The G7 emergency meeting today was about oil. Silver is not on their agenda. The structural forces that have been building in silver for 6 consecutive deficit years are completely untouched by anything that happened in that call. Section 4, the $85 ceiling, what the competitor got right and what the data confirms. The competitor's script made a specific technical observation that the data confirms. $85 has now rejected 4 times, 3 times on Friday, again today. Silver closed Friday near $84.40, rebounding from Thursday's $82.83 close, but still well below the $95.85 peak reached at the start of the month. The metal remains almost 10% lower for March so far after the early month sell-off. Y-chart silver is priced at $84.38 per ounce today, drifting slightly lower and consolidating just below recent highs after last week's sharp war-driven spike and a subsequent round of profit-taking. Metals edge 4 rejections at $85. The dollar gapped higher at Sunday's open, came back into the gap. Silver still could not close above 85s. That is not a dollar story in isolation. That is a structural ceiling that keeps holding regardless of what the dollar does. Analysts say the sharp swings seen in early March were primarily driven by positioning rather than a sudden shift in the metal's long-term fundamentals. Y-charts. Positioning, not fundamentals. The paper price is being managed inside a range. $79 held as the floor. That is the Sunday open deleveraging low. $85 is holding as the ceiling. That is the structural resistance where paper sellers have shown up 4 consecutive times. Inside that $79 to $85 range, the physical market is telling a completely different story. Brent crude and WTI are up roughly 37% and 40% respectively since the conflict began. Sprott money oil costs are up 40%. Silver mining costs are rising. The Shanghai physical premium is running $12 above Western spot. SHFE inventory is at its lowest since 2016. The 6-year structural deficit continues, and the paper price is holding in a $6 range. You can manage a paper price. You cannot manage the cost of pulling silver out of the ground when diesel has doubled. Section 5, the Shanghai data. What closed physical markets today while Western paper chopped? Silver remains underpinned by its dual role as a crisis hedge and industrial workhorse, supported by ongoing Middle East tensions, tariff and recession worries, and strong demand from solar, EVs, and AI-related hardware. Metal said Shanghai closed physical silver today at $96.85, up 1.7% on the session. The $12 gap between what Western paper claims silver is worth and what buyers in the East are actually paying for real metal did not close on a day when every risk asset was getting hammered. Think about what that means. On a day when S&P 500 fell 1.3%, when the Dow fell 1.6%, when oil went from $120 to $100, when silver hit $79 on the Western paper market, the Shanghai physical price went up 1.7%. Physical buyers in the East did not sell into the deleveraging. They bought. The $12 premium did not narrow. It held on the most volatile day in the oil market since 2020. The price mechanism is shifting slowly but visibly from paper-driven Western trading toward physical-driven global demand, particularly out of Asia and industry. Discovery Alert COMEX is not disappearing, but its monopoly over price influence is eroding in real time. The SHFE silver vaults shed another 3 metric tons today, down to 8.1 million ounces. Despite the violent price swings in late January and February, no meaningful new metal has arrived to replace what has been pulled. You can manage a paper price. You cannot fabricate warehouse receipts. Section 6, the bear case. Why $85 staying as a ceiling matters and what breaks the thesis. I always give you both sides. The bear case today is specific and you need to hold it. The 4 rejections at $85 are a documented technical fact. Until $85 breaks with conviction and holds, not a wick, not an intraday touch, but a closing candle above $85 with follow-through volume, the range is defined. $79 to $85. And if the Sunday open low at $79 fails on a renewed flush, the next structural support is not obvious. The paper sellers will not care what Shanghai is pricing when they are executing a technical breakdown through a key support level. The broader context remains constructive. However, analysts say the sharp swings seen in early March were primarily driven by positioning rather than a sudden shift in fundamentals. Y charts. Positioning drove both the spike to $95 and the crash to $79 in both directions. The same mechanism that flushed silver from $95 to $79 in a single session can push it from $84 to $72 if the macro environment shifts suddenly. Specifically, if the G7 confirms a full 400 million barrel SPR release this week and oil drops back toward $80, the inflation narrative weakens. If CPI comes in cold on Wednesday rather than hot, the stagflation thesis loses its primary data support. If a ceasefire signal emerges before March 27th, the war premium in both oil and silver evaporates simultaneously. The second bear argument, the DXY. The dollar gapped higher at Sunday's open and has come back into that gap, but there is still no closing candle above the January 15th level. If the dollar closes above that level, the next objective on the tape is the November 2025 high. And if that happens, paper metal prices go lower, both gold and silver. Silver specifically could go significantly lower given how it behaves in dollar strength environments. And given that it remains the most actively shorted commodity in the paper market, the price can be pushed well beyond what fundamentals justify when the banks get a window to act. The physical thesis does not change. The paper price absolutely can. Those are two different things, and you need to hold both of them in your head simultaneously. Wednesday is CPI. Any hot print hands paper sellers a narrative window into the Fed trap. Any cold print weakens the inflation hedge argument. Friday brings PCE, GDP, and JOLTS all in the same session. That macro data calendar is live ammunition for volatility in both directions. Section 7, the three scenarios. What happens before March 27th? 18 trading days remain before the March contract last trading day. Scenario 1, the range holds and the delivery clock forces the move. Most likely, silver consolidates between $79 and $85 through the first half of this week. CPI Wednesday provides the next directional catalyst. Meanwhile, the delivery drain continues at 785,000 ounces per day. By week 3 of March, the registered inventory has fallen another 11 to 14 million ounces from current levels. The paper market can defend $85 for another week. It cannot defend against math for 18 more days. The structural break comes from the delivery side, not from a macro headline. Scenario 2. G7 confirms full SPR release. Oil drops to $80. Silver tests $79 again, possible. A confirmed coordinated release of 300 to 400 million barrels pulls oil back toward $80 to $85. The inflation narrative weakens. CPI comes in cold Wednesday. Silver loses the $79 support level. Next technical support in the $70 to $75 range. The physical premium widens, but the paper price breaks lower. Stackers hold. Paper traders get flushed again. Scenario 3. $85 breaks with conviction. Possible, but requires a catalyst. A specific trigger. CPI hot print. Hormuz shipping ceasing completely, confirmed force majeure at COMEX, or a geopolitical escalation that produces a flight to safety bid, pushes silver above $85 with a closing candle and follow-through. The 4 previous rejections become a base. Next objective on the tape is $91 to $92, the level that the February 25th trading halt stopped silver from closing above. This is the scenario that produces the chart the competitor was describing last week. Section 8, your watch list, free, public, right now, $85 closing candle, not an intraday wick, a closing price above $85 with the next session opening above it. That is the signal that the paper ceiling has broken. Until that happens, the range is $79 to $85, and you trade the range, not the narrative. CPI Wednesday, 8:30 a.m. Eastern. Hot print above 3.2%, confirms the inflation trap, adds to the silver floor argument, likely gives paper sellers a short-term narrative window that produces a flush before the recovery. Cold print, below 2.8%, weakens the stagflation thesis and gives paper sellers a clean technical breakdown through $79. G7 SPR confirmation. Watch for a confirmed release announcement versus the current prepared to act language. Confirmed release, star short-term oil, bearish, silver pressure. No confirmation this week. Oil holds 100 plus, silver floor holds. CME daily delivery reports 4:30 p.m. Eastern. Today is day 9 of the March delivery period. The pace from the first week, 466 contracts representing 32.33 million ounces, is the benchmark. Watch whether today's delivery report shows acceleration or deceleration. Acceleration toward that pace means the delivery drain is continuing at the rate that mathematically exhausts current registered inventory before March 27th. Shanghai Premium versus COMEX. $96.85 Shanghai close today against $84.90 COMEX. That $12 gap held through the most volatile oil session since 2020. Watch whether it widens or narrows in tomorrow's Shanghai session. A widening premium is the clearest signal that the physical market is not accepting the paper price. Section 9. The honest conclusion. Here is the complete picture as of Monday, March 9th, 2026. WTI briefly breached $120 per barrel in overnight trading, the largest single-day gain since 2020. The Iran war has disrupted 20% of global oil supply for 9 consecutive days, more than double the previous record set during the Suez crisis. Sprott money. The G7 finance ministers said they are prepared to act but have not yet confirmed a release. WTI is trading close to $96 per barrel, up nearly 6% on the day after earlier spiking as much as 31%. Metals Edge Silver, $84.90, up from the $79 Sunday open low. 4 rejections at $85. Shanghai Physical, $96.85, up 1.7% on a day when Western paper got hammered. Goldman Sachs projects Brent crude to average $76 per barrel in the second quarter of 2026, but warns of potential spikes to $100 to $120 if the Strait of Hormuz closure persists. Crypto slate. The G7 did not solve the Hormuz crisis today. They said they are prepared to address it if it gets worse. The oil market repriced on the possibility of action. The physical silver market did not move. Shanghai closed up 1.7%. The $12 premium held. The vault keeps draining. The delivery clock has 18 trading days left. Today was not a silver day. It was an oil day. The silver story did not change today. It continued, beneath the noise of a 30% oil spike and an 18% reversal, beneath the headline of a G7 emergency call that did not confirm anything, beneath the $79 flush that scared retail investors and the $84.90 recovery that should have told them what the physical market thought of that flush. Watch for the volatility in energy markets to remain elevated. The most important metrics for the coming months will be the Brent WTI spread, shipping insurance premiums, and the operational status of Qatari LNG terminals. Add one more to that list, COMEX registered silver inventory. Because the G7 can release oil from strategic reserves, there is no strategic silver reserve. When the registered vault runs thin, there is no emergency call to coordinate a release. There is only the math. Respect the volatility. Short-term price action does not know your thesis. The $85 ceiling is real. The $79 floor held once. CPI Wednesday is live ammunition in both directions. Invest with logic, not hype. Protect your capital. Drop OG in the comments if you pulled the CME delivery report today and check the Shanghai premium yourself. And drop $85 breaks or range holds to tell me which scenario you think plays out before Friday's close.